Joining us here today to discuss how he's navigating today's market environment for tomorrow is portfolio manager Hugo Lavallée. Welcome. Great to see you in person.
Good to see you, Pamela. I'm
Welcome
happy to be here again. Right?
Yes,
We're
again.
together in Toronto, I think. I appreciate it.
Oh, it's a delight to have you here, and I know that everyone will send their questions in for Hugo over the next half hour or so. So this is a fascinating time, and your quote kind of points to all of this. Let's expand it a bit. Active managers are able to adapt, but you also don't want to get whipsawed by this. There's some vol out there. Tell us a little bit about how you are viewing actually the world of your investments right now.
Yeah, Pamela, like we've discussed internally, me and Connor Gordon, it's a volatility party and everybody's invited. And look, just to double click on what you just said, we invest for the world that we live in, not the world that we hope for. So I'm going to say a bunch of things for clarity. I don't want people sending emails angry. We're trying to call the world as we see it. Yeah. Look, the world's changed from, in my opinion, from global cooperation, we're all getting rich together, to my stick's bigger than yours and leverage. And
my stick is, totally.
It's become, leverage,
yes,
and
sure.
What's leverage? It's two things. It's bigger economy, bigger consumer economy, and it's bigger military. And Canada, we're not too bad from a consumer economy, but we're not that big compared to other countries. And we don't have a big military. So that's why I think you're going to see news that is going to be shocking to us as Canadians, or headlines. Mm-hmm. And I think they're all negotiation tactics. It's the businessman tactic and leverage, and I can leverage you versus that. And I think as Canadians, if you read the headlines, it's going to be sometimes a little shocking, like, oh, those 25% tariffs for fentanyl seems completely unfair. But I think everything will be negotiation, and it's just the world we live in. And we're going to have tariff to negotiate. We're going to, countries will have to hold their own on military spending. There's a couple of things that are going to come out of that. And I think every week, every month, there's going to be something new. And it's really about using the leverage of the team to try to navigate that.
Okay, well, let's talk about the team and ultimately what the team and yourself did sort of going into the election. We didn't know, nobody knew what the response was going to be in terms of the result. But you must have done some scenario and analysis of going into this. What did it allow you to do to, when you did need to pull the trigger, you could do it?
Yeah, so 7 floors up from here, we have roughly 30 North American analysts, and it's definitely the biggest Canadian analyst team in Canada. Probably have the biggest U.S. team, as far as I know. So we were getting ready, right, for the election, to be ready to react on November 6th, right? And so scenario analysis, companies, this and that. And, so on November 6th in the morning, I made some changes in Greater Canada. It was the presidency, it was not that surprising, but the red sweep, okay, that's a different scenario, right? It means for 2 years, they almost have carte blanche in terms of what they want to do. So now we can push. What's the agenda? What was in the podcast, right? Prior, what did they say? What do they like? What did they say that they like? What did they say they don't like? And made some changes. Like if you can buy a Canadian industrial company that's 90% US, that's non-tariff exposed, that might benefit from accelerated depreciation against taxes, right? So if you're a big capital spender, you get accelerated depreciation, you pay less in taxes, your free cash flow goes up, kind of reacting quicker than others on those. We saw what happened with crypto, which I don't want to, please don't ask me too much about it, but we saw, what happened with the crypto change, and what happened with, industrial companies, consumer companies. So, reacting a little bit quicker to that. The day that the tweet came out on the 25% tariffs, I was at my daughter's improv class, and I'm checking my Bloomberg between sets, and Canadian dollar's down like 1.5%, and what's going on. And by midnight, our Canadian team, like again, I said it's bigger than others. Our competition, 3 of them had put out every company under a 25% scenario. Our best guess, what's the impact? And the next morning, Moorhead did it. So just being able to react, because like you said, it's going to be important not to get whipsawed too much. It's very important. It's not about just making money, avoiding losses, having conviction. The week before the tariffs, it was the Doge, right? The Doge is going to kill government IT, And a lot of these stocks were down 20% in 3-4 days.
So that sounds like, so not getting whipsawed, but that also sounds like an opportunity.
Well, yes. So is it an opportunity, or actually has the world changed for these companies? Should we sell them even though they're down a little bit, right? So, or did we get ahead of it, right? We thought about the Doge and what that might mean for these companies. So I think it's going to be hell a little bit, frankly, for us as active stock pickers. But that's our job, right? It's our job to use those for opportunities and try to get ahead.
You said Greater Canada, for instance, is where you could take a look, make changes if you needed to. Just tell us about Greater Canada again. This is a fund where actually you can kind of go all over the place with this to an extent. Tell us about it.
50% minimum in Canada, or maybe it's 51. Let's say call it 50% in Canada. The rest I can do the rest of the world. I'm pretty much maximizing rest of the world, and 97% of the rest of the world, or 46, 47% of the funds, all U.S.
Okay.
So when we have a day like last Friday, when our unemployment rate in Canada surprises to the upside, I guess negatively, we're up 1% on the unemployment rate in Canada. Canadian dollar loses 1%. Well, if you keep the math simple, 50% Greater Canada is up 50 basis points as Canadian. So I don't know about you, but I look at my net worth in Canadian dollars. So it just softens the blow because it's every politician's dream. We're getting poorer, but together with a lower Canadian dollar. So, if we can have exposure to other currencies like US dollar, it helps to kind of navigate fund volatility. And that's one tool that we've been using. So as much as I'm a contrarian investor, it's hard to be bullish on Canadian dollar. The two drivers we've had, immigration and real estate, it's not, the narrative's not there, right? So I think for now, it still pays to be outside of Canada, and funds like Greater Canada try to maximize that.
So just to dig a bit deeper into the Canadian perspective on that. So this is, as a Canadian perspective, it's good to have exposure elsewhere, essentially, for the foreseeable future? Or at least a mix?
I think so. We'll see, right? I mean, the world might change tomorrow, and all of a sudden, price of oil is up $20 or whatever, and Canadian Energy tells a different story. But I think just generally, the fact that we don't yield globally such a big stick, right? True military and consumer-based economy. So, others will use it to their advantage, and it is what it is. And us as stock pickers is to try to navigate that and pick relative winners and try to avoid relative losers. Sometimes it's convoluted, a little bit complicated. Maybe there's a company that sells to the US consumer and they're going to do better, but there's a tariff threat. So how do you balance that in your head? How do you balance that in the portfolio? Do you really understand? That's one of the powers we have, because Fidelity rings really well with companies. They'll return our calls and they know us well. Okay, the plants, we can see in a 10K or an annual report where the facilities are. But what do you manufacture there, right? If you have a facility in Canada, does it sell to Canadians? No tariffs. Or might it sell to American? Potentially tariffs. So just trying to understand that, understanding our companies very well. And then us as PMs, we can make just better educated guesses and decisions rather on what we need to do to try to get ahead.
I mean, we don't know what all the policies will be ultimately in January.
Yeah.
So to what extent is there positioning, or is there actually just holding until you're a bit clearer on that?
No, look, the market moves fast, so I think you try to get ahead of it, right? So we were, I was already thinking in July, if there's a change in party, what does it mean? Right. Obviously I talked about November 6th, right? I probably made 4 or 5 decent changes in the Greater Canada Fund. Incremental, new positions, and the tariff stuff. How do we react to that? What do we think about? Now the Canadian dollar is going down, so we're thinking about we have some Canadian-based companies that have large U.S. businesses. Right. They're going to benefit when they're going to report next quarter. So we want to you want to make sure that you have all you're seeing clearly and all the cards are on the table, so you're not whipsawed and you're not surprised by things.
So the consumer itself, the discussion of the consumer, and probably this is the U.S. and maybe Canadian companies selling to the U.S. consumer. Discretionary was a wild ride through much of the year. It's obviously better now, and the American consumer looks better than the Canadian consumer. But let's discuss the consumer and how you invest for that over the course of this last year, but setting up for next year too.
Yeah, so thanks for asking, because it's one of the contrarian things that I've done. you were kind of using the world, it's been volatile, or I mean, consumer stocks have sucked, right? Like they've been terrible. They've been terrible stocks, and the one thing I think maybe a little bit differently than others, because they're a big part of the Greater Canada Fund, is on the vote November 5th, there was a lot of disenchanted people. They feel they haven't gone ahead the last 3 years, right? Their real income is either flat or down, right? Meaning their nominal income versus inflation, they haven't gone ahead and they're unhappy. So a lot of people woke up on November 6th with hope that, okay, maybe my situation now will change, or they voted on that promise. We'll see what happens. Wow. But I think for me, because you can think of tariffs, consumer, loser, right? That's like first level thinking. Another way to think about it is, I think there's the promise that we're going to try to do everything we can to make the great American consumer back and people feel rich and getting ahead. So can you get ahead of that? Because you don't have that visibility today, right? Or December 10th.
But you're assuming that because that was what the voter sentiment was.
And that's what happened the first 3 years of the Trump presidency, right? Like if you look at real income, my understanding, the real income of the first 3 years of Trump presidency were up 10% in real terms, right? For the average American. So there's cohorts of Americans, lower income, they're really struggling. Yeah. So they voted for change, right? So some of them voted for change. So in a way, it's, okay, well, if that change comes, which you can't see today, right? Because their budgets are stretched and they're shopping close to need, and they're struggling end of month because, the bank account's dry. Like, that's what we're seeing today. But can you invest for the next year or two on the promise that things for them, they voted for change and will things get better? So that's a big part of Greater Canada, which was horrible this summer. Like, these stocks had no bottom, and they've started acting better late September, early October, and they've continued to act a little bit better. So the real economy, transports, consumer, on the U.S. side, that's one area that I'm focused, because they're going to try to prop themselves up, right? I'm American consumer, you're a Canadian consumer. I'm going to try to win, and maybe you'll lose a little bit more, but I don't care. So I'm going to try to make my economy strong, and that's what they're going to try to do.
How do you think the world has changed? That might be what you just described right there, actually.
Yeah,
that may be the description.
From a father of three, I'm a kid from the 90s, right? So I grew up, globalization, you can travel anywhere, the world is yours, maybe more peaceful time, I guess, because we're all intertwined economic-wise. And now it just feels that it's, but that might not be good for us, because maybe we have an enemy or a perceived enemy that's getting stronger. So we need to win and they need to lose, or on a relative basis. So yeah, the world's changed and it is what it is. It makes me sad as a father of three, but when I put my investor hat on, right, which is my day job, or my full-time job, I guess, I go in and thinking, okay, that's how the world is changing, and I think we can benefit with the flexibility that we have in funds like Greater Canada to benefit for that. The other funds like Canadian Ops, there's a bunch of other things we can do from a Canadian company, but perspective. But just understanding, are they in the relative winner bucket or the relative loser bucket? And I think we can find our way through them.
Well, let's talk a little bit about how the Canadian economy can absorb some of the things that we're talking about. Like, there are some areas where there will be some shock absorption. I mean, energy seems to be one of the stories that's batted around. What else? How does the Canadian economy absorb some of the changes that are coming?
So I guess I would describe it as, how can we fight back, right? And one of it is oil, because absorbing is, they say jump, we say how high, right? If you look at the fentanyl comment, as Canadians, they seem completely unfair, because my understanding of it is it's 1,000 times worse at the southern border. So how can you put us in the same bucket? But everything's leverage. And the Quebec premier was right after, we need to secure our borders. That's what companies are saying. We can't deal with 25% tariffs, so spend $400 million and do what you need to do. So that's kind of, we don't have a lot of leverage there. But our leverage might come through energy policy and others, right? We're a big exporter of that, but
is that of interest to you?
Our relative stick is I think we just have to accept it is a little small, because we don't have a big consumer, we don't have it, but we do. Our leverage is what we export, right? We export lumber, even though they did put tariffs on it.
I was going to say that's a bit of a gnarly one to.
So yeah, they do care, but I guess they don't care that much because there is tariffs on lumber. But try to use what we can do. What we can do. I think in the first Trump presidency showed us, and I think that was one good thing that Prime Minister Trudeau did. You need to fly to Florida and have a dinner. And I think those deals will be cut at the end of the table. I think that's businessman deal.
And women. Yeah.
And women. Sorry, business person.
Versus
But I
person.
guess that his perspective is right now it's a businessman. But go down there and do what you can to soften the blow. And
is energy, oil, various producers, or in some ways all of the connected industries of interest to you because of that?
So let me unpack that a little bit. We're not bullish on the price of oil. There's too much of it globally, and there's a glut, and the demand's a little weak. So maybe that will change. But going into next year, it's hard to be bullish. Maybe if global economy gets better over time.
Right.
But right now, there's just too much of this stuff lying around. What's interesting within oil, there's two areas that are interesting, I think, are energy. It's not a big part of the fund, but like pipelines, getting our energy to market. Not super contrarian. One area that I've done well this year. We have a good energy analyst who gone on that. Is energy is a P times Q business, right? Price versus quantity, and we always focus on price, always. And I think, but focusing on quantity, like the world need Canadian energy. And we have better access to market now with Trans Mountain. So focusing on the quantity-based business, meaning royalties like basins. So the companies that are royalty-based, and they haven't had a great story to tell the last, let's say the previous 10 years, because the basin just hasn't grown. But now the world's shrinking. So Canada on a relative basis, where do you want to get, if you're Japan, where do you want to get your energy from, right? Canada also sounds really good.
This has been a story for years and decades. Is it actually going to be rubber hitting the road this time?
Well, yeah, because we weren't doing a great job. Our basins weren't growing. Yeah, it's a story.
We weren't doing a great marketing job either.
Yeah, but also providing the infrastructure to access the tidal water, right? Yeah. So I think that's changed. And you see in the basins, right? The basins are growing again after really not having grown that much. And on a relative basis, even though the price of energy is down, the royalty codes have done really well on a relative basis. That's one area and keen opportunities to take advantage of.
It's a great question coming in here. This has to do with, to an extent, what a stellar year it's been for equities, actually. How are you managing, Hugo, higher valuations, given that price and earnings are heading in different directions? Yeah, it's interesting.
It's a great question.
Yeah,
it's a great question.
Yeah.
Well, thanks for the question. I want you to know that Hugo has many, many ideas. And I was telling clients early this fall, I know the fund hasn't performed to the standard that we've set for it, but it's not like I have no ideas. I'm full of ideas. I'm full of contrarian ideas. Yeah. Because a lot of names are expensive. Visibility's been expensive, which means the cyclicals are not expensive.
Right.
And my funds are basically, they're all fully invested. I think they're all 5% cash or less. Greater Canada, I think, is 1% cash or less. For my style, I have a lot of ideas. So what's important is not to be too heavy in the, it's been a good momentum year, and a lot of names, Absolutely. They've seen multiple expansion, right? Yeah. So the 25 times earning company is now 35 times. I have some of those. It's not the majority of the fund. I have more the companies where the earnings have been cut. And maybe they used to make $4 of earnings, now they make $1.50. So those stocks on a relative basis, to me, they look really cheap. So that's why I'm navigating it. I think it's less so about talking about the overall market. Let's talk about relative sectors, one versus another.
You spoke to a French audience just before this one, and one of the questions Charles Denis was saying is, how has your contrarian style evolved, if at all? Maybe it hasn't, I don't know. But what would you say to that?
Well, it hasn't evolved, but I have a great quote to explain it.
Okay, good. You're full of good quotes, too.
I try.
Quotes. Yes.
So the quote is, I'm sure it was said in French, but here goes in English. So they've asked Napoleon, what was military genius? And he said, my best generals, or the best generals, are the one that can do the ordinary in extraordinary times, when everybody else is losing their minds. And I think it just, honestly, when I knew about the quote, when I reread it last week, it reminds me so much about what I try to do with contrarian investing. Everything we discuss in regular times. Stocks are down, buy more, don't panic, reinvest. Yeah. But there's moments and times in our career, right? Like, I remember November of 2008, like it felt like the financial system was going to collapse, or the first couple of weeks of COVID, right? Like March 18th.
The sky was falling.
Well, the sky's falling. And I think in those moments, to be able just to act normal, frankly, and see the world clearly and not panic. Because I've seen all, I remember talking to people on March 18, and other investors, complete panic, right? And a lot of my stocks bottom at 2 p.m. on March 18 during COVID. Just do the ordinary, what you're supposed to do. Which ones are our best companies? Oh my God, they're down 25% this morning. Well, I guess it's on sale versus yesterday. And just doing the ordinary in extraordinary times, I think it's a great way to get us ahead and not panic. And that's what I try. I think I'm just a little bit wired differently to be able to do that.
So it's interesting to have the word doing, ordinary linked to contrarian, because it doesn't seem like it is the ordinary, it's the opposite. But in that situation,
I guess it's extraordinary, because everybody else is, you have conversation with people and you can see, the panic in their eyes, and just being able to, in French, like, garder son sang-froid, be level-headed, and just keep doing what we've always done. And I think those moments lead to, extraordinary moments to get ahead versus others getting ahead versus benchmark.
Tell us a little bit about the tactical nature that your funds, some people, everyone's investing for the long term, but to what extent can you lean into things? Do you want to lean into things? Does that come into the contrarian? Or are you usually there for the long term?
No, I'm an active manager. Like, we've been talking about this for 20-something minutes, like 20-odd minutes. All summer, I think consumer stocks were on sale, and I leaned in. I call it leaning into the pain, right? I don't do it because I think I've lost my marbles, or I do it because I think it's the right thing to do to try to get the fund ahead over the next 2-3 years. To the best of my ability, when I look at the whole market, the work we've done, what are the companies that are on sale? And this summer, I think there was quite a few. And I think that's what's led partly to better performance since post Labor Day, but trying to look on a relative basis. So I'm still on that. Momentum has broken a little bit in the market, right? A tiny bit. Yeah. And that's partly why the fund's doing a little bit better. I'm not a momentum investor, not a very good momentum investor. So we'll see. I have no idea what next year is on top, but for me, it's just trying to do my thing, try to focus on where relative value is, and we'll keep pushing.
What do you want the team is doing all these amazing things, but what are you sort of hoping and asking them to focus in on for you? Can you give us a sense of, over the next, say, midterm, say 6 months, a year roughly out? What do you want to be looking for?
Well, I'm talking to the investment team on Thursday, so they don't know this, but I'll tell it just you.
Okay, good. I won't tell them.
Don't tell them. So I tell them, what I'd like you all to do is there's 2 things I'm going to tell them. Trust. It's all about trust in our business, right? We trust them. I'm here, so I can't be we have company meetings right now, right? So it's always about building trust, right? Trust that you're heading to the front line. I'm doing this. So there's that trust aspect. But the other thing is, we do rotations roughly every 3 years, and I tell them if you look back at your sector over 3 years, you should have one surprise that you've delighted us, one delight per rotation. You came and you pitched us a stock that we all went like, ugh. We don't want to buy that one because we have prior history, but the world's changed for them. I'll give you an example. Like 2 years ago, an analyst came to us like, you got to buy SNC. And my first reaction was like, ugh, I don't want to buy SNC, which is now Atkins Realis. And you don't understand, and this and that. And now the stock's tripled. It got kicked out at 60. The Stocks tripled. All three of my funds have benefited from it. And now it's like one of the only stock in the world that has a big nuclear business. It's hard to find nuclear exposure in the world. 20% of our profits is nuclear. So can you delight us once, like a real delight, like something that, and I think that should be the goal of every analyst, delighting us once. Look at how, when you look back, when you honestly look back at your rotation, there's always something that maybe others didn't see that you could have foreseen, and that's what I'm going to ask them to do. And I think it's a great way for us at Fidelity to get ahead of the competition.
That's really, really interesting. We began with this discussion of how to not get whipsawed. Just take us there a little bit more, because I mean the market vol, as we started this conversation with, since early November has been absolutely wild. And for lots of different reasons, because there's new announcements and the world has literally been changing underneath our feet. Just a word to advisors who want to make sure that what they're putting into their clients' portfolios is not going to get whipsawed. What do you say to that?
No, I mean individual company. We were talking about this actually literally this morning, that stock volatility around earnings probably has never been higher in history.
Interesting. Yeah.
But people need to remember that they own. If they own Hugo funds, every fund's between 50 and 100 names, right? So you might not even see it. And for us, it's about having conviction, knowing our companies well, that you don't panic up or down. Because in theory, if we do a good job, stocks will be pushed down too much on the way down, and we should be able to benefit from it, right? By buying stock maybe cheaper than we thought they could be bought at. Mm-hmm. And vice versa on the upside, right? I'm not big on price targets, but you'll have an idea what's a bullish scenario, right? Like a big profits, big margins, big revenue, big multiple, and once the stocks are there or above that or within 10% of that, well, what am I applying for now, right? So, and sometimes they'll be pushed to those prices or higher. So I think that the higher individual, people shouldn't feel it for the fund as a whole, but for individual securities, it should give us an advantage to try to get ahead. And that's what we're going to try to do.
It's fantastic. Hugo Lavallée, thank you for joining us in person, in studio. It's great to see you. Have a great holiday season.
Happy holidays to you and your family. Thanks for coming in.
Yeah, all the best.